if you can double down in September? What would it look like to do a 50 basis point cut in September?
All right. We'll see if that question gets asked. Lindsay, thank you so much, as always, for joining us on this Fed Day. Lindsay Owens, Executive Director of the Groundwork Collaborative and former Senior Economic Policy Advisor to Senator Elizabeth Warren, who, again, is encouraging Chairman Powell to cut
consistently.
Today. We're going to find out roughly 30 minutes from now whether that
Yeah, the building would shake. That would be like
happens.
one of the old Greenspan surprises in the old days here. The markets are certainly expecting good news here, Kaylee. The S&P has been up consistently about 1.5%. The NASDAQ up over 2%. You hate to think of what might happen if investors do not hear what they want.
Yeah, and again, the Fed doesn't like to take the market by surprise usually. So how will Chairman Powell walk that line today? If he's signaling a cut is to come, how does he make sure not too much easing of financial conditions happens as a result? He's certainly going to be facing some very difficult questions in that press conference where, of course, our very own Michael McKee will be in the room for that as we are really just counting down the minutes here now to the Fed's decision.
Yep, leaving in good hands, of course, with Tom, John, and Lisa. And we'll meet you back here at 5 p.m. Washington time for the late edition of Balance of Power. We'll be joined by Libby Cantrell at Pimco for her take on everything that is about to happen. So stay with us here with a special edition of Bloomberg Surveillance ahead. The Fed decides. Tom Keene, Jonathan Ferro, and Lisa Abramowitz here on Bloomberg TV and radio.
Earnings season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of Broadcom.
JPMorgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Live from New York City for our audience worldwide, the countdown to the Fed decision starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Bloomberg Surveillance, the Fed decides.
From New York City this afternoon, good afternoon, good afternoon. For our audience worldwide, that decision 27 minutes away. Lisa, a decision followed by a Chairman Powell news conference 30 minutes later.
The key issue is going to be how do they message how much closer they're getting to September? Do they talk about strength and resilience, or do they recognize weakness as a feature that they want to lean into with the labor market?
My message 30 minutes away is simple. Not that I thought it'd be a snooze fest, John, but yeah, I was interested. Fine. Things have changed and changed dramatically in the last 24 hours. The yield market is screaming the importance of this meeting.
5 consecutive days this bond market has rallied, and over the last 24 hours, the last couple of weeks, we've had warning after warning from prominent economists saying that the Federal Reserve should reduce interest rates, not in September. Lisa, the call is for this meeting.
Although even those economists say that if the Federal Reserve were to lower rates today, it would spook markets and cause a pretty big risk-off kind of move that would be problematic. I've missed this. Honestly, I'm just looking out and I wonder, how do they cater to these people by saying we're definitely going in September, and this is a reason why we still want to wait until then?
I'm away from the parlor game dramatically here. To me, it's the markets talking, and I'm looking at the 10-year real yield very elegantly off the setup I have. I'm sorry, as you mentioned, John, 5 days in a row, lower yields. And the key question is, and we've got a guest qualified here to lean on it, is are we breaking out of the range finally to a new vector of disinflation?
The lowest 10-year yield since March. We're down about 2 basis points on the session this afternoon. Lisa, you missed the grunting. Is that what you missed?
Yeah.
I mean, the sound effects.
There's a lot of things
The real-time sound effects.
John, we're doing a 4-hour meeting here, show today. There's a lot to talk about here to get to September.
I agree. A baby step towards September is the bulk of what many people expect a little bit later on this afternoon. Let's get you a check on the markets beyond the bond market. Equities with a real lift on the S&P 500, advancing here by more than 1 full percentage point. The dollar just a touch stronger here, Bramo. The euro negative by 0.1%, 1.08.
We have a stacked lineup. Coming up just shortly, we do have Bob Michele of JPMorgan. The world is coming around to his view, and after that, we're going to be speaking with Matt Lazzetti of Deutsche Bank and Kathy Jones of Charles Schwab, taking us up to that Fed rate decision at 2 p.m. Eastern. Then, get this, immediate reaction from former Fed Vice Chair Rich Clarida, who has his own own language to insert into the document that we're expecting to get from the Fed. I don't know if they're going to go with it. Diane Swonk of KPMG and Michael Gapin of Bank of America. And finally, following that news conference, this will be key, how he really guides the market heading into September and whether a 50 basis point rate cut is on the table, as some people are saying. We're going to be hearing from former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg.
Bill Dudley really changing the conversation in the last week or so. In a column on Bloomberg Opinion, TK, making a call. He said, I've changed my mind. The Fed needs to make a move.
So what you need to see a pivot like that, and it's not ex post. He's doing it in real time as the data comes in. And the huge theme today is this Latin idea. Michael knows the Latin, ex post, after the fact. We're going to wait. What are we going to do, wait after September?
Bob Michael of JPMorgan Asset Management with us around the table. Bob, it's good to see you.
Happy to be here.
Good afternoon. Let's get into this Fed statement. Drops in about 25 minutes. What kind of changes are you and the team expecting?
Well, I think there have to be a couple changes. I think when you look at the first paragraph and they talked about modest improvement toward their 2% inflation target, I think you can say considerable progress to their 2% inflation target. They have to open the door to a September rate cut. I'm in the market, by the way, so I'm part of the market you talk about. I'm just telling you, if they cut rates today, I would be spooked. And I think they should have set us up to cut rates today, but at the last meeting. So don't do it now, get us ready. And then I think they have to focus on inflation and employment. They talked about being in better balance. Now, inflation is kind of where they want it. Employment, I don't know. It seems to be leaking oil along the way. So I think they should probably drop in better balance and just say pretty well balanced.
If he performs at the press conference in a Bob Michael manner, does that put a bid to bonds where we see yields drive ever lower?
I think so. I think you just have to appreciate no one likes yields at this level. We look at the Fed funds rate, it's 5 3/8. We want to buy the 10-year at 5 3/8 to 6%. We could do that in 1994 and 1995, but that ain't now. And the fact that we're at these levels and everyone's fighting it, and there's still $6 trillion in cash sitting there because they feel cozy at money market yields of 5 to 5.5%, tells me there's still an awful lot of money to come into this market, plus everyone who's already in the market that took some profits.
Let's say Jay Powell doesn't want to spook the market, doesn't cut, but let's say he wants to dove it up. Let's say that he wants to really give a message that they are going to be accommodative. Could he open the door to a 50 basis point rate cut in September?
He could. He won't, because the other side of the coin is, while we're talking about the employment market is starting to leak a little bit, we're at 2.8% real GDP. You look at S&P 500 companies, close to half of them have reported, and 3/4 of them have beat the earnings estimate. So there is a large part of the U.S. economy that's doing pretty well right now. I don't think it calls for 50.
You said that you would be spooked if the Fed would cut rates today. Would you be spooked if they indicated a greater concern about an employment market that you say is leaky?
I think that would be a welcome acknowledgement of what we've seen in the labor market data, whether it's the unemployment rate now up 0.7% from the low, or when we look at the JOLTS data and the hiring rate has dropped and the quits rate has dropped. So there's some softening going on there.
If they've got unemployment year end at 4%, what's your underlying assumption, your base case for the labor market by the time we get to September, by the time we get to year end?
I think the unemployment rate goes a bit higher. I think you have to appreciate the policies that are in place today are restrictive. We're at 5 3/8% Fed funds rate. So that's brought growth and inflation down a lot. You can't just leave them there. And by the way, just bringing rates down 25 basis points, I don't know why the Fed is getting so wound up about that. They're just going from very restrictive to very restrictive minus a teeny bit. They're still in restrictive space.
I asked the unemployment question because I'm trying to work out whether this is truly a fertile environment for risk assets or not, and whether it will be by the time we get to September, October, November, December. If we're leaking oil now, where's the engine? What does the vehicle look like by the end of the year?
It's a Maserati driven by the FOMC with Fed in the driver's seat. And this is...
Should I be comfortable with that?
I don't know. You can look at that however you like. I tried to pick an Italian car for you.
I appreciate
that. I know
that.
you appreciate that. But listen, This is 95 again, where things look pretty shaky, but they took pressure off of businesses and households and started to bring the Fed funds rate down. We're in a soft landing. 4.1% unemployment isn't 5.1% unemployment. It's leaking the wrong way, and they probably want to start pulling that down right now, or at least stabilizing things where they are. You can start doing that with series of 25 basis point rate cuts. They have that power.
At every single meeting for quite a while. That's some of the calls that we've been hearing about. What have you adjusted? How much you think the Fed's going to have to cut rates to deal with the leaky engine in the Maserati that John is driving to the Fed's decision later next year?
I don't think as much as the market thinks. I think we're probably looking at, 75 to 125 basis points. Right. I don't think this is 200 to 300 basis points, which is what they've done in the past, because I don't see recession. I actually see that there's still a lot of money sloshing around from the fiscal programs. It's still being tapped by state and local governments. They're spending it, they're hiring, and that's creating economic activity.
I got an email in here, Alex in Washington. He was listening to Vice President Harris handle Bob Michael finance, investment, and economics, and it was not that good. I said, well, maybe Secretary Diamond will help. How political is this meeting?
Anytime you talk to a Fed official, they just bristle at the thought of politics behind it. I think they've got a lot of balls up in the air. They're at an interesting inflection point. If they had set the market up last meeting, they could have cut rates this meeting. They've got to get their messaging right for September. I think politics are the last thing on their mind right now.
Is this the way the Bank of England runs, John?
No. And if this was the Bank of England, we'd be talking about whether we'll get dissent in 20 minutes, and that question's barely come up, has it, Lisa, over the last few weeks?
No, but we also might be talking about a Liz Truss moment and how they respond to different political moments. So they don't have the privilege of acting recklessly, as one person I know tends to often say.
Who would say that?
I don't know.
TK brought up the politics. We can talk about a letter from Senator Warren and company, from the senators to Chairman Powell a little bit earlier this afternoon, saying maybe you should get a move on and cut interest rates. Bob Michael of JPMorgan is going to be sticking with us. Coming up in just a moment, we'll catch up with Kathy Jones of Charles Schwab alongside Matt Lazzetti of Deutsche Bank. Your Federal Reserve decision is around about 18 minutes away. And after that, a news conference with Chairman Powell 30 minutes afterwards. From New York City, this is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
Power, money, culture. As Linda Hammond tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's back. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We don't think the Fed is ready to cut.
See a July rate cut, I think would make me basically fall off my chair.
I think the Fed does cut in September.
September.
There's this growing dichotomy between Fed officials.
A lot of the kind of debate and discussion.
Those that are increasingly concerned about weakness, emerging weakness in the labor market, and those that are more focused on reinstating price stability.
I'm in the wait camp.
The Fed can take its time. We just hope they don't cut too soon should they cut in September.
We don't think they can go very far because of the underlying inflationary pressures.
I don't think the inflation drag has been fully swayed yet.
I certainly think the Fed has an argument to cut in July.
The labor market's feeling a little squishy here.
The Fed is late. They need to be cutting.
If it's so obvious that you need to move in September, then what are you waiting for?
Mission accomplished. You've achieved your goals. Let's get going.
Let's get going. That's the Wall Street chorus. Make a move in July. That July decision is 15 minutes away, but most people on Wall Street look for that move in September. Before that decision, going into it, the scores look like this on the S&P 500. A lift this afternoon, up by 1.4%. The Nasdaq ripping, up by 2.4%. Last time the Fed met in the middle of June, the Russell, the small caps, are up something like 10%. Over the same period, the two-year yield, switch up the board, it's down about 50 basis points. The two-year is down to 436.46. The 10-year is down for a fifth consecutive session at 411.23. And if you get to foreign exchange, we could talk about dollar yen. Lisa, dollar yen's an interesting one, gapping lower. This is a stronger Japanese yen to 150 off the back of a BOJ decision a little bit earlier. Will the Federal Reserve give them a helping hand in the next couple of hours?
That's the key. How much is this half BOJ, half cross your fingers and hope that the Federal Reserve is going to be dovish? What we got from the Bank of Japan was a 25 basis point, or actually it was raising rates to 0.25%, which is the highest going back to 2008, and having their bond purchases. This was unexpected, moving in the opposite direction. That did some of the lifting now for the yen. Now over to you, Chair Powell, and I wonder if they're staying up late over there.
We know that Chairman Powell has one gear on Fed decision day for the last 6 Fed decisions. This started with some work that Alan Ruskin did over at Deutsche Bank. I'm going to go through each date of the last 6 Federal Reserve decisions and tell you what the two-year yield did on that day. June 12th, down 8 basis points. May 1, down 7. March 20th, down 8. The end of January, down 12. The December meeting, we were down 30 basis points. The November meeting of last year, we were down 14. The two-year has rallied at every single Fed meeting, Lisa, over the last 6. Is this meeting going to be any different?
Well, if you ask Neil Dutta, they should go right now, and it should be a similar type of rally. You raise a question, though. Have we already baked in the likelihood that they're going to pre-commit to September? Is there almost buy the rumor, sell the news when they actually come out and do give some sense of that, given how far the rally has already gone? I think it's fair to wonder whether this would be the one where you get some sort of break.
Let's get to the guest panel. We've got Bob Michael of JPMorgan alongside us around the table for the next 40 minutes or so going into that news conference. Joining us now is Matt Lazzetti of Deutsche Bank and Kathy Jones of Charles Schwab. Kathy, I want to come to you first and just get your thoughts on the changes you're expecting or not in the statement that drops in about 12 minutes' time.
Well, we'll be watching for comments around that big comment about, we do not at this time see the case for lowering rates. If that changes, that they say, yes, they are prepared, they are seeing the case for changing rates, that would be really significant. Then there's the description of the economy and the labor market in particular and inflation. Are we going to go from inflation remains elevated to simply inflation is zeroing in on our target? So if they remove the remains elevated, that would be a pretty good signal that the Fed is feeling comfortable about that. A little bit more complicated how they describe the labor market, since it has been growing at a pretty healthy pace, a pretty solid pace. I think last time they described it as strong, and yet the unemployment rate has been going up. So I'll be interested to see how they do that. So it's going to be very interesting to see how they word this one. I think there may be some pretty significant changes to the wording so the Fed can lay the groundwork for a rate cut.
Matt Lazzetti, are we seeing a disinflationary trend clearly in the market? Yields lower. It's pretty elegant, to be honest. And is that based off real and nominal GDP that's coming down?
So I think it is, but it's certainly based on the fact that inflation has decelerated. I think the most important data point that we've gotten since the June FOMC meeting was shelter inflation coming down, rent and OER at long last, finally confirming what we've seen from the private sector data. I think for the Fed, the one reason to wait to September is they want to get confirmation in that downshift in rent and OER inflation, especially after being burnt a few times on the inflation front. I think that there's probably some scarring effects to that. That said, the labor market is showing some weakening. As Chair Powell said, it's had considerable cooling taking place. And so we think the Fed waits until September, but once they start with rate cuts, they then move every meeting for the first few meetings.
Fed chair likes to be a dove. John was pointing that out by how many times you see the two-year yield rally after a Fed conference for the past 5. Do you think that this time, he asked me this question, I answered, I'd love to hear your answer. Do you think this time could be different given the fact this market's already done a lot of work?
Yeah, I think incrementally he will sound dovish. So he's going to sound more dovish than he did at the June FOMC meeting, probably both from an inflation perspective and from a labor market perspective. Will that sound dovish enough from a market perspective? The market is pricing more than 25 basis points for September. There is talks about moving by 50 basis points or so. It's not clear at all to me that he sounds dovish relative to that perspective. So we are pricing a lot. It's going to be hard for him to kind of move in that direction relative to the market pricing. I would actually take your kind of comment back in time. We've done a lot of research. If you go back to the late 1980s, the 10-year yield, basically the entire decline in the 10-year yield since that period, has happened within short windows around the FOMC meeting. So there's this very long-standing regularity with which yields decline around FOMC meetings.
Matt Lazzetti, I'm looking at the clock. I know you've got to run. It's got to catch up with you, sir. Matt Lazzetti at Deutsche Bank. As we get closer to that Federal Reserve decision, about 9 minutes away, and this Federal Reserve seemingly becomes more confident about the outlook for inflation. Are they becoming increasingly uncomfortable with the outlook for the labour market? This quote comes from Neil Dutta of Runmac. Businesses are not desperate to find workers, and workers are not desperate to leave their jobs. Recruiting intensity tends to fall before firms resort to letting go of workers. Kathy, when you hear that, do you hear buy the 10-year bond in America?
Well, the 10-year's already discounted a lot already. I mean, where the yield is now has discounted several rate cuts and lower inflation. Having said that, I wouldn't be shy about buying 10-year yields here. I prefer probably closer to average duration, closer to 5 or 6, but I wouldn't hesitate to buy 10 years right here. I do think there's still some downside in terms of yields maybe down to the 380 area before this whole cycle plays out. But I wouldn't say it's the optimal place to buy treasuries.
John started the show by talking about Bob Michael's direction and yield here. And Bob, I want to go there. Ian Lincoln at BMO Capital Markets as well. I hear so few people modeling out a sub 4% yield. And you get there on the ambiguity of Fed this, Fed that. And the other is a legitimate slowdown, as I said to Matt Lazzetti, in real GDP. Your Bruce Kasman published a global disinflation. Is that because of a global slowdown and all of a sudden we're at a 395 10-year?
Absolutely. You're also seeing it in commodity prices.
Exactly.
They're starting to drift lower. Yes. So there's a slowdown, certainly in China, also Europe, and it seems to be coming to the U.S. I would also argue that I can present a range of measures. We're already at the Fed's 2% inflation target. Let's pick one of their own measures, the New York Fed multivariate core inflation measure, 2.06%. That's within rounding error of 2.0%. If you look at the 3-month annualized rates of core PCE and core CPI, they're at 2.3 and 2.1%. So we're already there.
Well, and Lisa, I don't mean to interrupt, but I have to do this because John forces me to quote copper off the London Metal Exchange. Copper's down 11% with that commodity shortfall we've seen. Nobody's talking about that.
One thing that's not down is sort of the riskier credit aspect. And we've seen actually what's not down is small caps. And Kathy, I'm curious whether perhaps this market has overpriced the soft landing. That yes, we're getting inflation down already, as Bob was pointing out, to the Fed's target. And yet the weakness has yet to fully come.
Yeah, I think the tightness in credit spreads at the lower end of the credit spectrum is a concern. We're seeing bankruptcies are up among small businesses. We're seeing consumers having trouble with delinquencies on auto loans, credit cards, et cetera. those are usually leading indicators of a turn in the credit cycle. Now, this one's been a little unusual, and that credit spreads continue to grind lower. But at some point, I think going down the risk spectrum is more of a concern than has played out in the market to date. So I would not be dipping down into those areas just on hopes that this is absolutely a soft landing. Right now, we're not calling for a recession, but the risk rises as you go forward, and you don't have a lot of risk premium left in those markets to cushion you if we do get a recession.
Bob, I'd love your take on this, not just whether we're going to have a recession or not, or whether this is a soft landing, but rather, is this market being overzealous in parsing out some sort of perfect scenario where credit can continue to do incredibly well, even in the riskier territories, even as you have slowing growth?
No, that's a soft landing. That's what soft landings are made of. It's great for markets. The Fed has done the impossible. I give them credit. I think it'd be interesting to hear from Kathy what her clients are doing. I suspect that they're not waiting for rates to come down. They're already putting money into municipal bond and U.S. Treasury ladders. So that money's starting to come in anyway. The Fed is going to be one of these lagging movers yet again.
You came very close to calling U.S. Treasury U.S. trash. And it made me wonder. Very, very close.
I thought it was U.S. tragedy.
I own a lot of them.
Trying to make some news here.
Trying to make some news here, TK. I do wonder what that looks like in 25. Had a lot of people talking about additional supply for the next 12 months. The supply story reasserting itself in the bond market. What do you say back to clients that bring up that one?
I think decisions that get made on Treasury supply are the worst things for investors to worry about. It's ridiculous. It doesn't move yields around at all. They price based on inflation and growth expectations. You look at where we are now, I can make the argument there aren't enough treasuries out in the market. The market's now scrambling to buy them 100+ basis points through the Fed funds rate. I think the other thing that gets forgotten here is that the Treasury is issuing to fund programs that the government is spending on. And that spending goes to hire people, create economic activity, and generate taxes on businesses and households. And I think that's what you see when the Treasury is telling you, actually, they're pulling back the amount of issuance in some of the coming auctions.
Kathy, I'd love you to weigh in here. Do you care about auctions? I mean, I care about auctions. I'm one of those people who focuses on absolutely the wrong thing. But Kathy, one of the reasons nothing changes, one of the reasons why is, especially now after the Bank of Japan is making a move and not absorbing as much, there's a question not of whether people can buy, but whether they are more price sensitive. Do you think that's of relevance?
No, I have to agree with Bob on this one. I have looked at the relationship between auctions and yields for years and years and years over various time frames and not found a correlation. And I think he points out very importantly that the demand has grown along with the supply. Now, never say never. Maybe Japan will exit, their current policy much more quickly than we anticipate, and Japanese households will switch back. But there's still such a huge gap between U.S. Treasury yields and Treasury yields in other developed markets that I think for a price-sensitive or a yield-sensitive investor, there is a very long way to go here. So I would agree with Bob. I'm just not focused on the auctions or on the supply story.
Kathy, before you go, and we've got about 2 minutes left before that decision, Bob did ask a question of you and what your clients are doing. Are they starting to get that itch, starting to worry about so-called reinvestment risk and deploying some capital out along the curve beyond just, say, the front end?
Yeah, we've seen that. And it's been something we've been suggesting for a long time because we do see reinvestment risk when the cycle turns. So, yes, we have seen a fair number of clients, heed that warning, and particularly using not just treasuries and not just municipal bonds, although the valuations there, if you're in a high tax bracket, can be pretty compelling on an after-tax basis, but also in investment-grade corporate bonds and other types of higher credit quality bonds where the yield curve's not inverted and you can actually hold on to some of these yields for 5 to 7 years.
Kathy, this was great. It's good to see you as always. Kathy Jones there of Charles Schwab, alongside Bob Michael of JPMorgan Asset Management. Bob's going to stick with us through this decision. On the other side, we'll hear from the former Fed Vice Chair, Richard Clarida. He'll be with us around this table in the studio. 60 seconds away. The scores going into it look like this. Let's start with equities and then we'll turn to bonds. Equities are positive by 1.5% on the S&P. There's a strong rally in the Nasdaq. The Nasdaq 100 up by 2.5%. Before today, through the close of yesterday, we were poised for the biggest monthly loss of the year so far on the Nasdaq and the biggest monthly gain of 2024 so far on the Russell. The Russell 2000 up by another 8 or 0.9%. Switch on the board and get to the bond market. The 2-year, we talked about it. The 2-year has rallied, Lisa, at every single Fed meeting over the last 6. On Fed decision day, is it going to be different this time?
Matt Lazzetti, I'm going to put this in his mouth rather than mine, was talking about how this could be just because we've already baked in more than a full rate cut in September and more than 2 full rate cuts by the end of this year. How much more can they deliver? That said, he has shown a willingness to really give a sense to what kind of weakness we see.
With your Fed decision, here's Mike McKee.
There is no change to interest rate. There are a number of small changes to the statement, but this is not a see you in September announcement. The Fed's forward guidance remains unchanged. Quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. There's also no change in the overall assessment that economic activity has continued to expand at a solid pace. All of the adjustments are basically to adjectives. Job gains have moderated, the statement says, instead of remained strong. Unemployment has moved up, but remains low. Inflation has eased over the past year, but remains somewhat elevated. And in recent months, there has been some further progress toward the 2% inflation goal. If there is a hint about the future, it's this. Instead of saying risks to employment and inflation have moved into better balance, the statement now says the committee is attentive to the risks on both sides of its dual mandate. The decision was unanimous, and that's basically it. If there is going to be a hint about a September move, it's going to be up to Chairman Powell.
It's a 2-part story, Mike McKee. This was the first part. The second part starts at about 29 minutes with that news conference and Chairman Powell. Let's get to the equity market. We stay positive on the S&P 500, up by about 1.5%. On the Nasdaq 100, up by 2.5%. In the bond market, yields look a little something like this. We're down about 2 basis points on a 10-year. The move at the front end of the curve, it's a small one, but notable, up by about 2 basis points on a 2-year at 438.32. I just want to get to those changes that Mike McKee identified. If you go back to the second paragraph of the June statement, the last line of that paragraph read as follows. The economic outlook is uncertain and the committee remains highly attentive to inflation risk. If you go to the second paragraph and the last line of the statement that just dropped, the economic outlook is uncertain and the committee is attentive to the risk to both sides of its dual mandate. And Lisa, this is the story of the dual mandate and the risks around it coming into balance. That looks like the way they formalised it this time around in the statement. And I just wonder how much the chairman builds on that in the news conference in 28 minutes.
I want to pick up on your point that the bond market isn't moving that much. There's only an increase of about 2 basis points on the front end. And that is why, exactly that, they recognize the risk that the labor market is one that they have to care about. This sets up Jackson Hole for him to come out and sort of change the framework. And then for September to be that first rate cut. No one's changing that view based on this particular statement.
The balance of risks has shifted and you start to see it appear just a little bit incrementally in the statement. The decision, rates unchanged. We're looking for a move still in September. To Lisa's point, we still have a news conference in front of us and Jackson Hole, the annual get-together in Jackson Hole, Wyoming, about a month away. With us around the table, I'm pleased to say the former Fed Vice Chair, Richard Clarida, is with us. Still with us is Bob Michael of JPMorgan Asset Management. Rich, it's good to see you, sir. Let's start with you. You listened to Mike, you saw the changes in the statement. What do you make of what we just heard?
Well, I'm a bit surprised, actually. I mean, not with the adjectives. They needed to change some adjectives up. But I was a bit surprised about the reference to the attuned and attentive to the balanced outlook. I mean, that's certainly correct. The chair's been making that point. But I think it is relevant that they included it in the statement. He will certainly, I think, reinforce it in the press conference. And I do think it does tee up Jackson Hole. There'll be some more information before then.
I look at, and this show's the best one we've ever done. We've got Dudley with with this important Bloomberg opinion piece a number of days ago. And I want to go to you on what you own, which is the high ground on the ex-ante, ex-post debate. You've got the Economist magazine article you did a year, whatever ago. You got your January 2022 context and consequences speech. You want an ex-ante aspirational Fed. I don't hear that here. They're waiting, they're waiting, they're waiting.
They are waiting. I think they are getting greater confidence. But I think the key point, not to toot my own horn, is my view all along.
But it's okay. It's surveillance. You can do that.
My
Farrell
view
does
all
it all
along,
day.
and I think I've said so on this show, is that the Powell Fed, really the goal was to get inflation to 2 point something, and then they would start thinking about the next step, which would be easing, not running an easy policy, but removing restrictions. So I do think this is what we're seeing. And if we do get the cut in September, as I think we and markets expect, it will be because they expect inflation ex-ante to continue to fall.
But are we anywhere near that? I'm sorry. This is an ex-post Fed going back to Arthur Burns. They're as data dependent as I've ever seen.
Yeah, they are data dependent, but I think that they attenuated and focused on the statement today, emphasized both sides of the mandate. So I do think they're looking at just the labor market as well as the inflation data.
Bob, what's your take on this? It seems like it's less dovish, a little bit more balanced than you initially thought. Do you think this just is trying to move as incrementally as possible?
I think they preserved full optionality heading into Jackson Hole. I also think that central bankers are mindful of what happened to the ECB earlier this year, where you could have made the same argument. If you're going to go next month, why not go this month? And then, of course, you saw what happened. So I don't see too much different than what we expected, other than they just decided to maintain the full optionality. We'll see what happens as we roll into September. We're still very much expecting 25 basis points in September.
Neil Dutta of Renmark just writes in, publishes, with language like this, it means the Fed will have to make a more pronounced shift in language in September. I'm surprised stocks are holding up well on this statement. Perhaps equities are looking ahead to the news conference. The news conference starts in about 24 minutes' time. He goes on to say, the Fed is waiting for additional data. Can they even articulate why inflation might re-accelerate from here? Can we pick up on that question, Bob? Can you articulate the risks around inflation? Why might it re-accelerate from here?
Corporate profitability still looks great. We talked about S&P 500 earnings. They're coming in ahead of expectations. You look at the guidance companies are giving you. They're up 12% next quarter. So we're not in a recession. We're slowing down in some parts of it. We'll see. I can't find really the argument what's going to cause inflation to reaccelerate, to be honest.
Well, Rich, we were talking about how this was definitely going to be unanimous. And I wonder how much of wrangling of cats there is in the room, and whether this is basically a representation of that there's some members who believe that inflation has been killed. It is nowhere in sight, that labor is important. And then you have others who say, well, wait for the year-over-year comps. Is that kind of what we're seeing here?
I think it could be an element. We've had some members of the committee, and I know most of these folks, but it's a different committee than the one I was on, and many of them do emphasize both sides of the dual mandate. So I'm sure that reflects a number of folks' views. I do think, though, this is a committee that certainly got burned earlier in this year because the inflation data went the wrong way. And to their credit, they became very data dependent, as Tom indicated. I think that they, put it this way, I think they think they're going to go in September. There is a range of data where they wouldn't, but I think it's a pretty small range. And I think that's really the balance they're trying to strike. And I think we'll hear that in the press conference.
We were speaking earlier with James Bullard, formerly of the St. Louis Fed, and he was talking about how he always raised the question at meetings that if you wanted to cut rates, most certainly at the next meeting, why not cut them now? Bob was sort of discussing that earlier. And it sets up this sort of difficult period of time where every data point could potentially upset the apple cart if it doesn't comply. Do you think that they are in that zone right now?
I don't really. I mean, I've certainly, during my time on the committee, we found ourselves there a couple of times. So it can happen. I think the data we have gotten, the chair did a lot of communication before a blackout, and the data since then has reinforced that view. So I think there's a pretty wide range of data where they'll feel comfortable going in September. So I don't think they're in that danger zone right now.
Can you confirm that Jim actually said those things at the FOMC meeting?
Well, of course, I would never reveal what was said in an FOMC meeting except what I say. All all the brilliant things I said. So
Diane Swonk joins us now from KPMG, alongside former Fed Vice Chair Rich Clarida and Bob Michele of JPMorgan. Diane, I want to get into this statement that came out about 8 minutes ago. What do you make of it, the incremental changes, and were you looking for something bigger?
I wasn't looking for anything bigger, and I think one of the key issues here is we saw Powell talk about in his congressional testimony when pushed on the dual mandate. He said, listen, this is the thing that keeps me awake at night. The number one thing that keeps me awake at night is that overshooting, the over-tightening. So that is in there, and that is what opens the door a crack, not wide open, which is what we expected for September. And I do think they're going to move in September, and I agree wholeheartedly with Rich on this. I think the other issue is there's sort of this tale of two economies we're seeing emerge out there. The one that's in the household survey that's close to but not yet triggered the Somm rule, which is what got Bill Dudley up in arms, and how weak employment has been in the household survey, and the establishment survey, the GDP data, other jobs data that suggests the economy is still on solid footing. And right now, the Fed has been opting into more of that establishment survey where payrolls have held up, although they're not quite as strong as they've been. We're going to get probably some good public sector hiring in the jobs numbers on Friday again, which will help buoy those overall numbers, adding to some weakness in the private sector. But I think that's important, is that the Fed is looking at this and they're weighing which is the right stuff. And, really getting to Rich's point, too, there isn't just one piece of data that the market keeps looking for that could tip the apple cart. The Fed is looking at the totality of the data, and that last line really gets to that point. The totality of the data will allow them to go in September, and they don't want to make the same mistake the ECB made, move and then have to freeze and be in a purgatory. Their credibility is at stake. They want to make sure inflation is coming down, but I agree with Rich, they'll still cut before inflation reaches its 2% target, anticipating that the economy, by lifting off that restriction, the economy will get there.
We have Swonk and Clarida with us. Bob Michele, maybe a question for you on the economics of the moment. Are we slaves to measured? We have measured for decades. We're being very measured where maybe other central banks aren't. Are we just so afraid to move, and we're over careful, over cautious, because once we move, we've got to move in a measured vector?
I feel like we're back to the Greenspan Fed, where every word is so carefully thought out. It makes you want to overanalyze it, and no one can give an inch. If the wrong word is in there, then the FOMC gets concerned about the market pricing in hundreds of basis points of rate cuts and risk assets being up tens of percent.
Okay, please go.
But we're talking about, and Rich touched on it, we're in, I think, very restrictive range. 25 basis points, you're not in a loose monetary world with money flooding all over the place. You're still restrictive. You've got to start that journey somewhere.
This is too important. Lawrence Meyer, Washington University, his monograph, A Term at the Fed. He tore Greenspan apart, that it was a dictatorship. Are we getting to the point now no one can dissent and everyone's measured because we're measured and appropriate?
No, I think no one has dissented, because 2 years ago inflation was too damn high and they were all agreed they wanted to get it lower. It'll get more interesting as we get close. But what I want to say, to invoke the Olympics now, this is a Fed that really wants to stick the landing. They won't say this word, but their projection and what we're seeing in Bloomberg consensus and elsewhere is a soft landing, and they want to stick it. And, the data is now solid, is moving in the right direction. And so, getting back to the Greenspan Fed, there was a soft landing or so in those years. Alan Blinder has written, they're not, common, but we do see them. I think in 2019, I think the Powell Fed got a soft landing. We don't see it in the data because we got the pandemic. The economy looked pretty good in January of 2020. So they're trying to stick the soft landing.
Forget about sticking the landing. Let's just throw them in the Seine. The water's fine. They'll be okay.
You win. Better analogy.
Right.
Okay.
There's another analogy. Matt Hornback puts this out earlier, and I'd love your thoughts on this, Diane. Basically, the Olympic motto, to carry on with this, reads faster, higher, stronger together. Could have been used to talk about central banks globally altogether. Now, it might be more apropos, slower, lower, weaker together. Diane, how much is that looming over this Fed meeting? The idea not of synchronized swimming or synchronized rate cuts, but this idea of trying to sort of take an edge off for the rest of the world that really does seem to be dealing a little bit more with some negative growth?
I don't think that's the Fed's main concern, and I'm sure Rich will back me up on that. I remember seeing Ben Bernanke actually go after another central banker who said, you guys need to change your policy to help us out. And he said, that's not our problem, basically, at a Jackson Hole meeting. So that is not the Fed's primary concern. That said, a strong dollar helps us out down the road in keeping goods prices lower, so that helps the Fed out. I think what's more important here in terms of the Olympic analogies is that the road to gold is often paved with tears and obstacles. And I think people forget that, and I'm thinking of Simone Biles here. I'm sorry, she's my hero and heroine at this point in time. But I'm thinking about, soft landings. People forget that the 1994-95 situation, it looks great on paper. I lived it. I remember it. Rich, you lived it too. It was ugly at the time. Chairman Greenspan's reappointment as his third term as Fed chair was held up for 4 months in 1996 because he nearly crashed the economy in 1995, and people were so angry at him for not easing sooner. And it was his own colleagues, including Janet Yellen on the Fed, that got him to experiment with productivity growth and intense foreign competition, that bringing down inflation and allowing the unemployment rate to fall instead of using monetary policy to do it. That is really important to remember, is that soft landings are not easy. They look good on paper, but getting there can be a hard path.
Diane, where does the confidence come? Where does it come from that unemployment stabilizes at these levels and doesn't carry on shifting higher into year end? What underpins that?
Well, I think, I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly. All I know is that even Claudia Sahm, who wants the Fed to cut right now, has argued her own rule might not be applicable in the post-pandemic economy because of all the changes we've seen. We've seen much of the rise in unemployment has come from more people seeking jobs, an increase in the participation rate, particularly among prime-age workers. We've seen an influx of foreign workers, foreign-born workers, accounting for over 70% of the growth in the civilian labor force since February of 2020. That's helped to buoy the unemployment rate as opposed to a surge in layoffs. That doesn't mean there aren't stresses in the labor market. That doesn't mean there aren't still problems. But at the end of the day, what is it that people complain most about? They can complain most about the high level of prices still. And that's something that the Fed also has to keep in front of its mind. And I think that's where we're at. At the end of the day, we don't want to lose this and not hit that soft landing, but it's a rocky road to get there. I think we're still going to make it, given the fact that we saw the positive of consumers pushed back in the second quarter on price hikes, and retailers and producers capitulated. They rolled back prices on goods, and we saw a rebound in growth, doubling the pace of the first quarter, driven in large part by a rebound in consumer spending. That's the Goldilocks scenario towards a soft landing.
There's this issue, Bob. We're looking at market pricing. And right now it seems like this is consensus, that they are going to land the soft landing, even though it is sort of a rarity or a white elephant. Do you think that the market has overpriced that soft landing or even underpriced it because the internal skepticism just keeps on roaring?
No, I think the markets are right on track with the soft landing. And if it in fact happens, the Fed can bring down rates a fair amount, and the markets will continue to appreciate. I think what's different this time is the Fed and investors have a lot more real-time information. I was around in 94, 95. I was around in 81. And you didn't have that information. And now you have it. It's real time, it's live, you can see what's going on. Businesses have it, households have it. And maybe it gives policymakers a false sense of comfort, but they have that sense of comfort.
Which really kind of leaves the market kind of in the way, sort of in the same boat that the Fed is in. And I wonder, Rich, if you were still on the Fed, how much the Fed looks at the market to kind of gauge progress, sort of follows them, if you will, because they are gauging real-time data. And if anything, this is the collective will. And I love the war stories from the mid-1950s from everybody. But I wonder if, if that's something that they could really kind of sink their teeth into.
Oh, sure. Well, I mean, I'll just speak for myself, but you're looking at the market, hopefully to try to extract signal. There's always noise. You have to be honest with yourself. But it's particularly relevant for things like the growth outlook and the inflation outlook. You need to know what is being expected. That's a key input to monetary policy, our expectations. I gave one of my speeches at the Fed was on this point of avoiding the hall of mirror problems by looking at market prices. So I'm not saying it's easy, but I don't think there's an alternative.
I want to cross back over to Diane. Diane, I know you've got to go in a second. Just a quick final word. A question for Chairman Powell in this news conference. Diane, what would it be?
Well, this is on communications. I think it's going to be very hard for the Fed to communicate. We've already seen financial markets are trying to front-run the Fed on a larger cut in September. Yeah. How do they calibrate their communications to deal with what may be more measured cuts?
Interesting. Diane, thank you. As always, Diane Swonk there of KPMG. If you are just joining us, welcome to the programme. The Fed decision came out about 20 minutes ago, unchanged on interest rates, and the statement largely unchanged as well, just some incremental changes. So the focus on the news conference now, which starts in about 10 minutes' time. With us, joining us now, I'm pleased to say, is Mike Gapin of Bank of America. Michael, going into this news conference, very incremental changes in that statement. Were you expecting more than what they delivered?
No, I wasn't. I think with the strong growth numbers we received, the right place for them to make adjustments is exactly where they did. Reflected a little bit in cooling labor market conditions, reflect a little bit more progress on inflation, kind of pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental move. I think the Fed feels that it's in a sweet spot right now, that the data is moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence, may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael, the data that backs up your view, what separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets. And we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September. So September can happen, but it may not. So I think that's how I'd frame it right now.
Michael, let's just put a bow on this. What does further progress look like to you in the 2 labor market reports and the 2 inflation reads that we get until the next meeting?
Well, I think the labor market report is maybe a little more asymmetric. A strong report's probably not going to prevent them from cutting, but obviously a weak one could. So if they feel the labor market is softening more than they expect, they could go in that regard. Otherwise, I think to your earlier question of what's going to cause inflation to rise, I can't see it. I agree, but I don't think what they can rule out right now is that inflation settles in at a level that feels a little uncomfortable for them. So I think on the margin, a little more evidence that no, we're not going to get stuck with, say, core PCE in the high 2s. It does look like it's moving lower. So 1 or 2 more reports that give them confidence about that, then I think is probably enough.
Speaking of discomfort, we know a topic they're uncomfortable with, and that's politics. And if it comes up in this news conference, we know what Chairman Powell's going to do. He's going to ignore it. But there was a letter sent to him by Senator Warren and company. And TK, there's a quote in this letter. The immediate press release read as follows: "The failure to cut rates would indicate that the Fed is giving in to bullying and is putting political considerations ahead of its dual mandate to promote maximum employment and stable prices." So you've got the Republicans saying if you cut rates, it's political. And you've got the Democrats saying if you don't cut rates, it's political. sort of stuck in a rock and a hard place between the both.
And what's important here, John, it's so important, is that Richard Clarida is one of the people that brought history back to economics with his work at Columbia. I sat at the Fed with you in that magnificent library of first editions, and Elizabeth Warren reached down and said, take the book off the shelf. And I took Torsten Veblen, The Theory of the Leisure Class, off the shelf, and you and I were talking about it. This is a few years back. That's what Senator Warren's talking about, is the Gilded Age. Are we in a Gilded Age where the elites are talking only to the fancy people and indirectly doing monetary policy only for the fancy people?
Well, no. In one word, I think the Fed has the dual mandate. Inflation was too high. They're focused on both sides. I think the economy's in a place where it can certainly adjust and wait another 2 months until the cuts commence. So I would push back on that.
Mike Apen, would you push back? Just how relevant is the U.S. election and U.S. politics?
Well, the way I would frame this, and I think Rich would agree, I was formerly on staff at the board, and I learned quickly that no matter what you do or don't do, somebody's going to be upset, and one side will complain or the other will complain. So I think you learn quickly the best thing to do is to do what you think is right. So I would put it at that. So they have competing opinions here. The right thing to do is to do what they feel is right.
Mike, I'll finish with the same question I finished with Diane Swonk. Questions for the chairman. If Michael McKee's listening, going into this news conference, what's the number one question for you?
Well, the chair has said that they could ease if there's unexpected weakness in the labor market, which is actual data that comes in below their expectation. But what about preemptive easing on the risk of labor market weakening? I think that might get at the gap between market pricing and what the Fed thinks it will deliver.
Mike Apen, thank you, sir. Michael Apen there of Bank of America. The news conference about 5 minutes away. Bob, there is a question here about what kind of interest rate cut it would be when we get one, if we get one in September. Is it a risk management decision? Is it a mid-cycle adjustment, the beginning of something much bigger than that? Do you think they have to frame it at this point? Do you think they have to characterize what it might be?
I think they do, and I think they'd like it to be part of the normalization process, that they've achieved their targets on both sides of their dual mandate, and they could start to bring down what is a restrictive policy.
Michael Apen echoed your speech of January 2022. It's ex ante aspiration. I don't want you to voice for the chairman. I know that's inappropriate. But how does he voice the aspiration of getting out front here in 6-7 minutes?
Well, I think he'll stick to the mandate, and he'll stick to documenting the progress. And again, he won't use the word soft landing, although that's, I think, what they're trying to achieve. And I think Governor Waller's done a very effective job in his many speeches in making the point that they have time because the data is holding up quite well. It was a very bold call a couple of years ago for Waller to say we can disinflate without this huge pain in the labor market. I think they were prepared to take it if it was required. It hasn't happened. And so now I think they're even more focused on the soft landing. And I do think they do want to avoid a premature declaration of mission accomplished, because even if underlying inflation's going to target, there's always noise in the data. And 2 or 3 months of noise on the wrong side is a bit uncomfortable.
Rich, there's this feeling baked into markets that Fed Chair Jay Powell is much more dovish than the statement might suggest. Are you expecting that tone to kind of come out in the news conference?
Interesting. We heard a lot from Chair Powell at Centra on Capitol Hill, sitting down at the Economic Club of D.C. I've gone through and looked at that. I would actually expect him to stick pretty close to that, which was very balanced, not declaring victory, but acknowledging progress, emphasizing, as the statement does today, that they are really attuned and attentive to both sides of the dual mandate. So there are some times where I think the press conference is really the chair using a lot of, this is what I think. I think we'll hear a lot of this is what we think today. I think the committee's pretty tightly aligned on where they are.
Bob, what are you listening for today?
I actually think he will come out a bit more dovish. I think that's the way he's rolled the last several meetings. He's surprised us by deviating from the script and indicating that, yeah, you know, he could see rate cuts on the horizon. I can't take my eyes off of the last sentence in the second paragraph, where the committee is attentive to the risk of both sides of its dual mandate. I got what I wanted, at least, which is acknowledgement of risks in the labor market. The more I look at that, the more it's clear to me that they're going in September. If I were Mike McKee, a lot of people tried to press the Fed on what their neutral long-term rate is. I would ask him, at what level is the Fed funds rate no longer restrictive?
Do you think they can answer that, Rich?
Well, I think they won't answer that. I think they have and this is one where there are probably 19 different opinions on the committee. One thing I'll say a little bit is right now, as I look at my Bloomberg screen, or I did 25 minutes ago, September was more than 100% priced, and even I wouldn't say it's 100%. There's data we could get between now and then where they might not go. So that's why I skew a little bit to being a little bit more balanced than maybe dovish, but you know, we'll find out.
I'm pleased you brought up Sintra Portugal, because I think it's really important to reflect on the comments from Chairman Powell back in Sintra Portugal at the ECB's annual get-together. Chairman Powell was talking about the strength of the labour market, and the strength of the labour market being a reason for them to wait, that they have time. They can wait and see. A few more months of data, maybe. And it's his characterisation again in this news conference of the labour market that I think matters, off the back of that incremental change in the statement that you're all picking up on around the table, that last line of the second paragraph. You've seen this incrementally in the Fed speeches over the last few weeks, Lisa, the last month. They're placing greater emphasis on the other side of the mandate in a way that it wasn't even part of the conversation a year or so ago. Think about where we've come from. 2 years ago, Jackson Hole, August 2022, pain to get inflation down. The focus was getting inflation down. And you can start to hear the focus shifting to the labour market. Let's take a listen to the chairman of the Federal Reserve, Chairman Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby. Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really, the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell with Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're under-reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer-Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question, the time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, in the last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. you really do now see the restriction. Whereas, I mean, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation. Rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we didn't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are it's just difficult to do. So I look at both. But I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings, and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine.
There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to get ahead of the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off anymore for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see which way the economy heads, and I think if we are to respond to weakness, we're certainly well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks. But nobody has great vision deep into the future. In terms of a reaction function, that's a long time discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have, on a CBDC, we don't have any plan to. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That wraps up the July Federal Reserve News Conference with Chairman Powell. If you are just tuning in, welcome to the program. Let's wrap that up for you. This market got the dovishness it wanted to hear. The equity market's positive by close to 2% on the S&P 500. On the Nasdaq 100, up by 3.3. We're moving closer to cutting interest rates. September could well be on the table. Push that through the bond market, a fifth consecutive day of gains for the 10-year Treasury. Yields lower. We're down by 4 basis points on a 10-year. It's a break of 4.1%. So we've all got the same question. Just how low is the bar for a rate cut in September? This is what the chairman had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So let's talk about the calendar. The next meeting, September 18th. The data in between. August 2nd, this coming Friday, payrolls. August 14th, a CPI report. September 6th, the jobs report. On the 11th, another CPI report going into a Federal Reserve decision week. And most people assuming after that, Lisa, we're like this far away from that interest rate cut.
Especially at a time where there was a different type of language in this communication. We are not data dependent. They are data dependent. They're not data point dependent. They want to draw a distinction that one data point isn't going to throw them off materially. They repeated the totality of the data as well as how they just need to see the same kind of good data that they've already been seeing.
The time continuum to me was critical. I thought Steve Leisman's question was great about measured. He alluded to this. They're slaves to measured, John. That's all there is to it. I just don't know what else to say. I'll talk to Dudley about it here. To have Clarida and Dudley with us today is
fantastic.
It's just lights out. And I really, for those of you at Global Wall Street, what's coming up here with Dr. Dudley is required listening.
There was a fantastic line that came from Evercore's Krishna Gua. I want to share this quote with you. He thinks they've laid the foundations for a rate cut in September. I think a lot of people observing that news conference would agree. But this quote's interesting. We think in practice it's not very data point dependent and view the cautious evolution of the statement as intended to carry hawks along and avoid dissents, as was indeed the case today. Expect a clearer signal a month from now at Jackson Hole. I'm thinking about the minutes as well. I just wonder how well set the stage is for the Doves to dance and sing very loudly in these minutes that come out in a number of weeks' time.
I was very happy that the reporter asked him to elaborate on the fact that at this particular meeting, they did discuss the possibility of cutting rates, that there were a few members, but not the vast majority. Here is the question. How loud was that voice, and what did they have to give to those people to get on board with them in terms of this decision?
As you bring in Dr. Dudley, moments ago, the 10-year yield broke down to a 408.92. It's a new low yield. Can you imagine, John, what our shows are going to be like with a 399 10-year? I can't get there.
Where are we going to be in September? Where's the unemployment rate going to be in September? That's the big question I have going into the payrolls report this Friday. Bill Dudley got a shout out in this news conference. Bill Dudley joins us now, the former New York Fed president and Bloomberg opinion columnist as well. Bill, I want to go to your column that you wrote in the last week or so. It was quoted in this news conference. I'm sure you heard it. What did you think of the chairman's response to it?
I thought it was a fair response. I mean, this is my opinion, and the Fed is reaching a slightly different opinion. I mean, we're at a point where the risks are pretty closely balanced, and so the question is, do you go a little earlier or do you go a little later? I think, the reason why I thought it made more sense to go is that if the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a big deal, a lot of difference. But I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Bill Dudley, your essay heard round the world, the single sentence, the Fed doesn't want to be fooled again. You've held court at Princeton, where the late, wonderful Daniel Kahneman held court. Here's Kahneman with Tversky. Decision makers know they are prone to regret, and the anticipation of that painful emotion plays a part in many decisions. How is regret aversion playing in to this massive data dependency ex post ballet?
Well, what may be happening here is the fact that they got fooled on inflation, early this year, where the data came in bad, makes them, overly cautious that they're going to make this, that they could make the same mistake again by going early. I think it's, economists talk about recency bias. You put too much weight on the most recent experience. So this may be a case where they're not putting enough weight on the fact that, things are slowing and the inflation's coming down, and maybe now's the time to act. I think it was interesting. You got a question about the SOM rule, the fact when the unemployment rate climbs above 0.5% on a 3-month moving average basis, you always have recession. He said he's aware of it, but clearly the Fed doesn't put a lot of weight on that risk.
Do you feel like we're getting closer to the moment where we will see real dissent on a committee that's being cobbled together, and you can kind of feel the strains in some of the communiques?
No, I think what happened today was basically the Doves got a pretty dovish statement and a pretty dovish press conference, and so they're sort of set on board, and the Hawks got more patience. And so when you arrive at the September meeting, assuming the outlook doesn't change in a material way, and that's basically what Powell was saying, it's not about a single data point. The outlook has to change in a fundamental way for the Fed not to go in September. At that point, you have something to basically give to both the Doves and the Hawks. The Doves, thank you for being patient. The Hawks, we waited, so let's go together unanimously at the September meeting. So I think there's a good possibility that you'll see a unanimous vote at September for a 25 basis point rate cut.
Bill, you brought up the SOM rule. The chairman also brought up the yield curve in this news conference as well, and highlighted the false positives we're getting from traditional indicators. Just to reflect back on that piece that you wrote for Bloomberg Opinion, can you walk us through why you do think actually the SOM rule does matter? That maybe we should have a little bit more of a focus on these traditional indicators still and not completely ignore them?
Well, if I can start with the yield curve, the reason why I don't think the yield curve is necessarily a good predictor is the yield curve is inverted because people think monetary policy is tight. So it's not the yield curve shape that causes the economy to weaken. It's the presumption that monetary policy is restrictive that causes the economy to weaken. Most of the time when the yield curve is inverted, monetary policy is tight, and so the yield curve is a good predictor. The SOM rule, I think, is a little bit different. It's basically saying once the labor market deterioration goes beyond a certain point, it becomes self-reinforcing. Essentially what I think happens is households hear about the labor market weakening, they pull back on their consumer spending. That causes businesses to pull back in terms of investment and hiring, and that leads to further weakness in consumption and then further rises in the unemployment rate. It's a pretty amazing statistical regularity that either rises less than 0.5% or next stop is a full-blown recession. There's nothing in between. The smallest increase in the unemployment rate, trough to peak, is either between 0.5 and 1.9 percentage points. There's nothing in the middle, which I think is pretty interesting statistically. Now, he did recognize that as a statistical, just a statistical result. There's no economic law behind it, but the track record is 13-0. So think about the odds of flipping a coin 13 times and coming up heads every time. After a while, you're sort of going to believe that the next flip is going to generate the same result.
Bill, take us back to first principles. Why can't they just cut and say one and done and we'll observe versus our addiction to measured?
Well, I think what will happen is once they start to cut, they'll probably keep going. Once they start to do the first rate cut, they basically decide that monetary policy, that we've accomplished our mission in terms of inflation and unemployment. Policy is restrictive, so we now have to go back to neutral. Neutral's not 25 basis points away. So if you have a rate cut in September, it's probably going to be followed by rate cuts, at least one or two more rate cuts later this year.
Bill, it seems like this was a setup for Jackson Hole. We've been talking about that. And it seems like there will be some sort of policy regime shift that we will observe in August. What do you think it will be?
I don't think that Powell really needs to say much more than what he said today, frankly. I mean, I think the changes in the statement and the press conference today basically tell you that September is going to happen unless the economic outlook changes materially. Now, that's possible. You could get a whole string of bad inflation numbers, or the economy could come in hot. But I think in the next 6 weeks or 7 weeks, is the outlook going to change materially? I doubt it. So I think regardless of what happens in Jackson Hole, I think the Fed's going to cut in September. I think, Powell will sort of check in at the Jackson Hole and basically, probably confirm that we're still on track for this result for a rate cut in September. But I don't think it's, I don't think he has to use it for that.
Well, although it's not just about September, it's not just about whether they're going to move again one more time this year. It's about what the destination is. It's about the pace. It's about what the goal is in terms of just the view of where the economy is. Bill, do you expect there to be any discussion about the terminal rate, about what it means to be neutral at a time where this is a very different economy than pre-pandemic?
Well, I would assume that once you get inflation, you're highly confident that inflation is going back to 2%, and you think the labor market's in balance, then presumably you want to go back to a neutral monetary policy. And the question is, what's neutral? And that comes down to that whole question of what is the level of R-star, the neutral federal funds rate. I think that neutral is clearly, lower than where we are today, but is it 100 basis points lower or 200 basis points lower? That remains to be seen. So the Fed's going to be sort of feeling its way. Now, obviously, if we fall into recession, then the whole story changes. Yeah. Because in a recession environment, the Fed doesn't want to go to a neutral monetary policy. They want to go to a stimulative monetary policy. So if we actually, if it turns out with the benefit of hindsight that the Fed is late and we have a mild recession, then the Fed's going to cut rates much more dramatically.
Bill, I've never said this. I've got Dudley, Krugman, and Blinder on the same page. Never did I think I'd say that. The money paragraph from your good friend Alan Blinder. Any such early cut should be accompanied by a warning not to expect a steady stream of rate cuts. He alludes to the ECB. Do we need some ECB religion at the Eccles building?
No, I think that the Fed will probably cut more than one, because once you start to cut, you're basically saying, I think it's time to remove monetary restraint. And monetary restraint is not going to be removed with just one 25 basis point rate cut.
Bill, great to get your thoughts. Appreciate it. Bill Dudley there, the former New York Fed president, weighing in on this Federal Reserve decision, as he got a lot of people talking over the last week about the need to move in July at the meeting that's just passed. I want to bring you a headline. Comes from the New York Times, and it reads as follows. Iran's supreme leader ordering a retaliatory attack on Israel. The New York Times citing 3 Iranian officials briefed on the order. This is what I can tell you about crude. Crude's been rallying all day, and the price of crude looks like this at the moment. Brent crude up by 4 percentage points. TK, you would often say overtaken by events. The last thing this Fed needs over the next month or so is an energy price shock.
I'm so glad you brought this up, Jen. We led off the show this morning with Ethan Bronner, our Tel Aviv News Bureau chief, encyclopedic on the region. And he says the position here now is unprecedented, and he made clear there's going to be immediate news following both from the north to Lebanon and the news that you just have from Tehran
as we get those updates, we'll bring them to you. I just want to reset. If you are joining us, we've just had a Federal Reserve decision in the last couple of hours. Interest rates unchanged. Incremental changes to the statement. There was a sense that in September, the Federal Reserve chair would set us up for a rate cut in September. He took a baby step towards doing so, and the market picked up on things accordingly. Big rally across equities, on the NASDAQ, on the S&P, on a Russell. It looks like this right now. It fades just a touch, but we're still higher by 1.4% on the S&P. Bear in mind, the NASDAQ was poised for the worst month of the year, and at one point in the last couple of hours was on course for its best day of 2024. That fades. We're back down to about 2.7% higher on the session on the NASDAQ. We referenced this stat a little bit earlier on today, a few times. We are now on course for the 7th consecutive Fed decision day rally on a 2-year bond. Lisa, that yield is lower by 6 basis points.
How much is this just that Jerome Powell tends to skew dovish, and how much is this that the market still has a probability or a possibility baked into what the yield is that the Fed could maybe surprise in a hawkish manner? Either way, this is a market that likes to hear Fed Chair Powell speak, and today was no different.
Mike McKee was in the room with the Federal Reserve Chair down in Washington, D.C. He joins us from the nation's capital now. Mike, you've just got outside. Walk us through your biggest takeaway from that news conference this afternoon.
Well, I think what you walk away with is what Bill Dudley was talking about. If the economy doesn't do something weird, change positions, change directions, then the Fed is going to be cutting in September. But there are a lot of potential twists and turns between now and then. Friday is event risk with the jobs report. And of course, you just mentioned the situation with Iran. I don't think the Fed was taking those things into consideration today as reasons not to move today, but they do have to worry about them and what might happen. Right. So they will, at this point, be on a cutting course unless something significantly changes. And I think that was the message that Powell wanted to deliver. And I think Bill put it well when he talked about how the statement was skewed to the doves a little bit and the news conference maybe to the hawks, and that both sides get something out of it.
Mike, you've been doing this for a few years. Back to McChesney Martin. We almost printed a 406 10-year moments ago. Can the bond market tell the Fed what to do?
Probably not. And one of the things that you have to keep in mind is that we have all this international news going on, and the U.S. bond market is the haven market. So a certain amount of what's going on today is probably in reaction to Israel and Iran. And a certain amount of it is the politics going on in this country. And then on top of that, what the Fed is considering and what the economic data are showing. But I suspect today's less about the Fed and the data than it is about other things, because the market had pretty much priced for a September rate cut. They didn't get any surprises out of the Fed today.
Mike, you're referring, of course, to the news that John broke about Iranian supreme leader ordering an attack on Israel for the two assassinations that Israel carried out. Right now, we're seeing crude markedly higher, particularly Brent crude. Mike, I wonder how this relates to what Fed Chair Powell has been talking about, that this is actually better inflation data today than it was, say, late last year or earlier this year, simply because it is not being driven by goods. It is being driven by the employment market. It is being driven by services. How much do you believe, based on those comments, this is a Fed that is willing to look through good side inflation and focus much more on something else?
Well, I think they are, especially if oil prices go up only temporarily. The problem is if oil prices go up for quite some time, then that feeds through into the real economy, particularly on the services side. You'll see surcharges by delivery companies, airline fares might go up, that sort of thing. So they're going to have to keep an eye on that. But their general instinct would be to look past any kind of energy price change that comes about that they think might be temporary. And at this point, we have been waiting for a major shift in energy prices since October 7th, when the first attack on Israel came. So we haven't seen it yet. Let's see whether this holds or not. And then the Fed would have to take it into account if it's still going on.
5% rally in crude today. Mike McKee, great work as always, sir. Appreciate it. We'll catch up with you a little bit later. This week's not over. Still got some work to do. The Fed decision behind us. Tomorrow, we'll get jobless claims. On Friday, we'll get a payrolls report. And we'll be catching up with Jeff Rosenberg of BlackRock. We can do that now. Jeff, at 8:31 on Friday, will this decision today to do nothing, will that look like the right one?
Well, you know, it might look like the right one, but I think the point you're also getting to is that Friday, and we'll see on Friday as well, is going to be much more consequential. But I think the important point about how it's going to be more consequential is what we've heard from everybody so far, what we heard from the chairman and in the statement, is this is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much stronger, then you're going to have some disappointment. If the data comes in along lines of what Chairman Powell was talking about in terms of gradual normalization, or even, you know, a little bit weaker than that, the market will continue to price in this path of a cut in September, a cut in December, and even more into 2025. So I think Friday, the risk is really on the upside, that you get a surprisingly strong payroll report, and that has to call into question whether or not policy is really as tight as it is. And that's really the issue. Everyone's kind of saying, hey, this is right, the Fed's got it right. The Fed's saying we've got the soft landing. We want to secure the benefits of soft landing. But he kept repeating PDFP at 2.6%. You look at the GDP number that just came out. You look at Atlanta Fed GDP Now forecast for third quarter. We are well above, in growth terms, anything associated with long-term sustainable growth. And so, yes, we've seen some signs of restrictiveness, but how much of that
Hold up,
restrictiveness?
Jeff, because you're
and that's where
going
the asymmetry
totally
comes
against the grain, totally against the grain. And I think you know you are. Most of the people coming on this show right now, if they're going against the Federal Reserve, they're saying it's because they think this Fed is too tight, not restrictive enough. You're making the point here, Jeff, that maybe they're not as tight as they think they are. Now, that really goes against the grain, Jeff. Is that the point you're trying to make?
That is the point exactly that I just made. No one's really talking about it because the Fed's not talking about it. But the data is what your question was about. What happens on Friday and how does that make this moment look? Well, if the data comes in continually stronger, then we're going to have to start to talk about that. Now, I'm not saying that that's where we're going. Where we have been, and what we tend to do is to extrapolate where we just have been. So we're extrapolating out the benefits of the gradual slowdown in labor markets, the normalization. ECI is another great data point. There's nothing in the crystal ball that says that that won't happen. But your question was, what if it does? Then you start to think about these things. And my point is, everyone is so one-sided on this point that the asymmetry to the market reaction is much greater to the upside surprise and strength on Friday than it is to coming in line or even being weaker.
So let's put a call around that, Jeff. Are you basically selling two-year notes right now, trying to lock in because you think that this could be the highs, given that they are not recognizing the risk of an upside surprise to the jobs report?
No, I wouldn't say I'd go that far, but what I would say is it tempers some of the enthusiasm for adding to 2 years at this point when it's all in the price and even more so relative to what the Fed is saying that you're going to get. So the bar is a little bit higher to what do I do with this information in my portfolio when you look at, well, you know, the bond market's really quite priced a lot of that in. So it makes it a little bit more tricky than just saying, oh, the Fed's going to cut rates and I should back up the truck and buy a whole bunch of duration. Well, a lot of that trade has happened in the last month. So if you're just talking about maintenance cuts and the degree of maintenance cuts that are required, is what you were talking about with Bill Dudley a minute ago. We don't really know where that neutral is. So how do we know where neutral is? You know it when you see it, meaning you know it when you see it in the data. So if the economy doesn't slow and that unemployment rate doesn't continue to rise, and it says you're not so restrictive as you think you are. And I think, you know, we just kind of have a pile up on one side of the debate here when the data is still saying 2.6% PDFP. He said it twice during the press conference. He also said the other thing that has been supportive of restrictiveness, interest rate sensitive sectors and the slowdown in the labor market. But it's a more balanced view around this debate around how restrictive we are than where the market is kind of lining up. And that sets up an asymmetry to the outcomes.
Hey, Jeff, you're a great student of history. And if we have the headlines that John Farrow was talking about there of Tehran and Israel, and for that matter, up to Lebanon as well, how far out the full faith and credit curve does politics, does war, do our fears play in? Is it short term? Is it out to the 2-year pinch? Or is it out even further to the 10-year note?
So I'm going to frame that in that question, or my answer to that question, in terms of how does the kind of flight to quality response in the bond market play out in this environment. I've said this on the show maybe a couple of times. We've written about it. That flight to quality during the QE zero interest rate policy environment was a curve flattener. If you're very close to zero rates in the front end and you're looking for portfolio protection, you buy it in the long end. Today, we're in a very different environment, 5.25 to 5.5. There's plenty of room for the front end to go down. And so it's more of that pre-GFC kind of bond market reaction where flight to quality is a steepener, and it's in the front end of the curve. So I think you see the most powerful reaction. It's hard to disentangle the high frequency between the news that Jonathan broke and the result of the press conference, but you do see a little bit of a steepener move into the market. Again, hard to disentangle the two, but I think when you take a step back, flight to quality now is the steepener trade, and your better yield response is going to be more in the front end in this kind of environment.
What's interesting to me today, Jeff, is what's not rallying on the heels of some of those headlines, especially in light of the Fed's dovish tilt, yes, but they did not cut rates. It's that the dollar is not catching a bit. It's weakening pretty dramatically. You're seeing the Bank of Japan very happy today. They're getting what they wanted in terms of a little bit more yen strength. How much is this sort of the new narrative that in a flight to safety type of moment, if the Fed is going to cut rates and not recognize that upside risk, you will see persistent dollar weakness heading into next year?
It's a tricky one, Lisa, because, on the one hand, you've got kind of interest rate differentials driving some of those dollar moves, clearly, with the yen, balanced against the other side of flight to quality, which is the pure risk-off trade, is usually dollar strength. You go for the strongest institutional protection in terms of wealth, and so I think initially the move is much more about interest rate differentials, and that's why you're not seeing so much of the move on the dollar. I think it's too soon to say whether or not you're going to see a bid to the dollar from geopolitical risk. But I think if it was a larger issue that spreads, you're going to think more traditionally that's going to be dollar strength.
You got to jump John and gold up $41.
Got a big rally in the bond market too, and equities as well. Jeff, just final question before I go. There's people watching, listening to this program right now. They just want to know, can I buy the S&P 500 and take a vacation? Is there anything to worry about between now and September?
Well, you never want to say take a vacation.
No.
Buying equities, you've got some risk, but you take the totality of what the chairman went over. And this is a lot of good news. I mean, this is a chairman basically saying, without saying it, we've achieved the soft landing. That's a great outcome for the equity market. It's a great outcome for the economy. It's a great outcome more broadly. So I think that's the takeaway, and generally that's going to be pretty supportive. I think the other thing just to mention, obviously, you're not really buying the S&P 500. It's not the economy. It's a collection of stocks that has a very high weight to a secular technology theme, and that secular technology theme is playing out again today following Microsoft's earnings. You're seeing a bid back to semis. So you've got like the micro story there a lot, as well as the policy story. And we got to keep that in mind when we're looking at this high frequency data. And if you're buying the S&P 500 with a very high historical share to tech, it's really also buying into that tech story as much as it is about the macro economy.
Just trying to take a vacation. Jeff, appreciate it. Jeff Rosenberg there, BlackRock. Jeff, thank you. Deeply thoughtful stuff going into payrolls on Friday. We should share with you the numbers that we're looking for on Friday. Just another sneak peek of the payrolls survey here at Bloomberg. The median estimate is 175 on Friday. The previous number, 206. Unemployment coming into focus much more for many of you, I know. So here's the estimate for unemployment, 4.1%, in line with the previous month of 4.1%, Lisa.
And the reason why it matters, that unemployment rate, possibly more than anything else, is because if it gets to 4.2%, it triggers a SOM roll. Bill Dudley talking about why that's important. At that point, historically, it becomes a self-reinforcing mechanism of weakness.
The difference is you and I are taking vacation like 18 hours. Pharaoh's taking 18 days. That's the difference here.
Actually, I'm missing Friday because I'm going to be on vacation.
Thank you.
You're missing job site? It's un-American.
It had to do with kids' schedules.
Look, as a manager here at Bloomberg.
Blame it on the kids.
As a manager here at Bloomberg.
Are you going to blame it on the kids?
I track everyone's vacation.
Oh, do you?
Absolutely.
Yeah, is that correct?
You've both taken much more than I have.
Oh,
okay?
Please.
Just for the
record. Do you
record.
have a bar chart of it?
I do. At home, it's a spreadsheet. I load up the Bloomberg terminal and I monitor your vacation at the same time.
That's such productivity.
Missed this, haven't we? Appreciate it. It's good to see you, TK.
Yeah, please.
Thank you, sir. Lisa, thank you.
Thank you.
Are you going to bless us with some of your criticism of the Federal Reserve tomorrow?
Yes, I'm going to have commentary that blesses them very frequently.
Is there an auction tomorrow?
No, but there
That's
is
the line of the press
commentary.
conference. That really is. Coming up on the close, don't miss this. Stuart Kaiser of Citi, David Kirkpatrick of Economist, and a former Fed Governor, Betsy Duke, as we round out the month of July from New York City. This is Bloomberg.
Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport, it's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
Power, money, culture. As Linda Ammon tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's back. Asia is here.
inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
An affirmation of investor expectations. This is the countdown to the close. I'm Romaine Bostic alongside Alex Steele and Scarlett Fu. On the heels of a Fed meeting, we talk about a rate hiking cycle that began almost 2 years ago. A rate hiking cycle that, if you believe what Jay Powell had to say today, might officially be over.
Yeah, but for now, it's higher for longer. I wonder if he could have just wrapped up the press conference by saying, wait for Jackson Hole.
Oh, maybe. There we go. That's how you're going to lay the groundwork for September. Just checking on the markets here. You have the S&P already grinding its way higher today, but you can really see a tick higher as the statement came out, particularly when Powell talked about September. We had a little bit of a dip, though, into the close. Also, the two-year yield, guys, that's a perfect example of what we're looking at. There you go. He says the word September, and yields go down for the day, down by about 6 basis points. I feel like this chart tells the story.
Absolutely.
It's kind of interesting, too, to see just how many times that September narrative kept coming up again and how many times he was willing to lean into it and not shy away from it. Obviously, making it clear, nothing's been decided, as he always likes to say, but it sounded to me like maybe some decisions might actually be on the table.
Maximum optionality, right? That's been the mantra this whole time. Well, we know Fed Chair Jay Powell hinted that rate cuts could be on the table this fall, perhaps September, but only the data really boosts their confidence. Take a listen.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
For some market analysis, what the impact of all this is on equities, if at all, let's welcome Stuart Kaiser. He is head of equity trading strategy over at Citi. And Stuart, I know before the FOMC decision and press conference, your take on this was that markets, at least in equities, are really much more focused on earnings. Did this idea of a rate cut in September change that idea?
I don't think it really changed our base case. This morning we were really rallying on, the Microsoft earnings from last night and some related earnings there. The FOMC, I was actually kind of surprised. I mean, the statement was a little probably more hawkish than the market might have expected, and equity futures didn't react as much, which did surprise me. I think once we got into the press conference and it became, clear that the Fed was sort of parroting what we've seen from the data, right, which is a solid labor market, easing inflation, and kind of a cut-minded FOMC, the market did respond positively to that. But, if I were to rank out the big catalyst this week, I would probably put earnings and payrolls a little bit ahead of the Fed in terms of the impact on markets. And I think that's kind of largely what you saw this afternoon in totality.
When you talk about, Stuart, the idea of what this market is pricing in with regards to rate cuts and this idea here that the Fed, at least right now, seems to be leaning into this idea that the data is pointing them in that direction, will that take precedence, whether it's at September, November, or in the December meeting?
Yeah, it really does matter, especially to the extent that they're actually cutting rates into a solid economy. And, our view coming into the year was you don't need rate cuts, but if you are getting rate cuts, it's the why that matters. And if they do 2 or 3 cuts and you're priced for about 2.5 cuts in the fourth quarter, and that happens against, let's say, payroll data that's still 150 to 200K, I think the markets will respond exceptionally positively to that. If they end up cutting, but it's in response to a weaker labor market, to me, that's a much, much different discussion. And I do think you have to worry about equity risk in that case. So, yeah, look, I do think insurance cuts in the back half or in the fourth quarter this year would be extremely positive for the markets. But, the real question is going to be, are they cutting into a strong labor market, or are they cutting because they're really worried about a deteriorating labor market in the next few months?
Yeah, which sets us up for Friday. And it was very apparent in Powell's presser that the job data is that critical metric for a September cut. What are the options market? What's the options market in the S&P telling you for Friday now?
Yeah, I mean, you're pricing, something like a 1% move on Friday, which is a pretty large implied move ahead of a payrolls print. That said, you also get Apple and Amazon after the close on Thursday. So I think that 1 to 1.2% move has kind of been fluctuating throughout the day. I think that's capturing payrolls as well as those kind of key earnings prints. But look, our baseline view for equities this year is you run long equity risk unless and until the U.S. labor market comes under significant pressure. It does seem like the Fed is also kind of navigating in that direction, too, with kind of payrolls as the number one thing they're focused on. So it doesn't surprise me to see a lot of risk priced into payrolls because, we do see it as kind of the key risk indicator for markets. Consensus about 175K. Our U.S. economists are actually a bit below that. And I do think if you printed something sub 150K, it would definitely get the market's attention in terms of, kind of a broader slowing in U.S. labor markets.
Stuart, you say that earnings matter for the big cap tech stocks. Clearly, the jobs report matters for the equity market as well. Do earnings matter for the Russell 2000, or is it still a rotation that continues because of the macro trends?
Yeah, look, I do think earnings obviously matter for small cap. It's a little tough because, only about 700 stocks in the Russell actually have positive earnings. So, like the day-to-day, what is EPS on the Russell probably matters a little bit less than are we continuing to get soft landing data. But, so I think earnings matter more for S&P and NASDAQ right now, sort of, tick by tick, day by day, what are companies reporting. But look, the Russell is a more growth sensitive equity asset, and it's going to respond to that growth data because it is translating through to, what is the earnings profile and what is the credit risk of those small cap stocks. Honestly, one of the things we've been really focused on with investors is owning small cap, but doing it through that smaller kind of 600 to 700 stocks within the within the Russell 2000s that actually produce positive profitability.
Are those correlations still there, Stuart? I mean, when you lay out that scenario, that sounds to me a little bit more idiosyncratic rather than something that is broadly defined.
Yeah, look, I think coming into earnings season, folks were looking at least at large cap tech earnings as a little more idiosyncratic. But the problem or the challenge is within that tech ecosystem, there's a lot of feedback, right? The CapEx that's getting spent by, let's say, a Google or a Microsoft or a Meta, that CapEx is then getting kind of consumed by NVIDIA and the semi stocks. So as much as you do have some idiosyncratic stories, you also have, I think, this very strong interlinkage amongst those large cap tech stocks, which is why the Google report last last week, which kind of hinted at maybe some weaker CapEx, became so disruptive. At the Russell level, yeah, I think there's a lot more idiosyncratic risk down there, but it's just also not as well covered, right? There's not as much consensus coverage of those names. There's a little bit less focus, I think, on stock by stock or company by company. What are they doing from an earnings perspective?
All right, Stuart, got to leave it there. Stuart Kaiser, head of equity trading strategy over at Citi, on the heels of a Fed meeting where the forward guidance left unchanged. The adjectives did change and the financial markets largely unmoved. As we push ahead now to a whole slate of earnings coming after the bell, guys, that includes Meta, Etsy, Qualcomm, Carvana, and MGM, and quite a few others.
Yep, and we got eBay as well. I think Meta's going to be quite interesting, right? It's like, as an investor on Meta, do you want to see them spend more on CapEx? Probably not. But if you're looking at growth and nice hyperscaler CapEx, you want that growth in the market, maybe you then do want them to spend.
And come on, the advertising business is doing well. They've got the Summer Olympics. They've also got the election, and the election is only heating up. So the outlook for advertising seems pretty solid.
All right, looking at the 7th consecutive Fed day now, where we've seen the short end of the Treasury curve move lower and a huge rally going on in the equity space. Strongest day right now for the S&P since February. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele here to help take you through the closing bell, a global simulcast. It starts right now with Scarlett Fu alongside us in the television studio, Carol Massar and Tim Stenovic in the radio booth, as we welcome our audiences across all of our platforms, including our partnership with YouTube. A day where we're looking at an S&P having its best day since February of this year. The NASDAQ 100, Carol, having its best day since February of last year.
I don't know about you guys, but I lost count of how many times Fed Chair Jay Powell said September, and I feel like that specificity was so important and
I know.
a key
I thought
takeaway.
at some point, like Earth, Wind, and Fire was just going to like pop out.
I love that you think that way. Cue the song. Cue the song.
Okay, though, to be fair, he did say we've made no decisions about future meetings, and it includes September. We'll be data dependent, but not data point dependent.
September.
I didn't hear September in that part.
Yeah, I'm just going to say.
Yeah, no, I mean, they're setting it. I mean, I think the question is, are they dragging their feet or are they taking baby steps? And how you kind of look at that. I saw notes from a lot of economists referring to either one of those.
Well, I mean, he needs to create room for optionality, and he certainly gets that with Jackson Hole in late August. So you wonder how much they're going to say September and Jackson Hole as well.
It'll be interesting to see whether he uses that platform. It's kind of interesting. We heard from Bill Dudley during the Fed special. He kind of talked about this idea here that if the Fed does indeed cut that first rate cut, he thinks they have to keep going. They can't do like what you're seeing over there in the ECB as sort of do one and then wait. That if this is going to be an easing cycle, in his words, it needs to be an actual cycle.
And he said several, right? Like he said
Yes.
the word several.
Yeah.
So it just depends on what the word several actually means. Is that 7 or is that more like 3 or 4?
That next meeting, of course, September 17th, 18th. Apologies to Earth, Wind, and Fire that it did not schedule it for the 21st. We get the closing bells here in New York on this Fed day, Wednesday here, with a lot of earnings set to cross the wire. Dow Jones Industrial Average up 100 points or 0.2%. The S&P 500 up about 1.6%, while the NASDAQ Composite higher by 2.6%. And the Russell 2000 also in the green by about 0.5%. Carol.
All right, folks, let's get to Qualcomm earnings. Great read on certainly the smartphone market. So let's get to it. Let's get to the outlook. Fourth quarter revenue, $9.5 billion to $10.3 billion. So kicking it up, the estimate on the street is $9.7 billion. Fourth quarter adjusted EPS, $2.45 a share to $2.65. The estimate is $2.45. So again, upping both the top and bottom line. Go backwards. Third quarter adjusted revenue, $9.39 billion. That's a beat versus the estimate of $9.21 billion on the street. And third quarter adjusted EPS, $2.33 a share. That's 9 pennies better than what the street was expecting. And that stock you're seeing up 3% here in the aftermarket.
Yeah, certainly waiting for some commentary. The company has not updated its financial results on the website yet, so we don't have the press release. But it does see fourth quarter revenue, $9.5 to $10.3 billion. Estimates for $9.7 billion. Shares up by 5.3%.
And just quick mention here with NVIDIA's move today. It was the biggest gainer in the NASDAQ 100 on that positive note out of Morgan Stanley. It added $329 billion in value today. That is the most in market history. $329 billion.
Yeah, I was looking at the Philadelphia Semiconductor Index earlier today, and up the most going back to late 2022. Everything in there other than Skyworks and Energis were in the green, and solidly in the green, too.
Yeah, well, a batch of semiconductor, right? ASML getting a boost, right? There's some exemptions maybe when it comes to some of the chip equipment makers. ADM, Advanced AMD rather, Advanced Micro Devices, right? Also their report upbeat in terms of their forecast. So there was a lot of news, I felt like,
Intel
in the chip
also.
space.
Intel making some big news yesterday with layoffs. So, yeah.
And it'll be interesting, too. We get Intel reporting tomorrow, too. So maybe some of that gloom and doom or these doubts here about some of these chip companies, maybe they'll start to ratify some of those valuations. In fact, we're getting more earnings right now out of ARM Holdings, too. Of course, a big one there with that company providing guidance saying that revenue for the quarter going to come in at about $780 to $830 million. So basically a preview here of that second quarter. And the revenue in the most recent quarter, the past first quarter, the fiscal first quarter, a beat there as well. 939 million. Street was looking for 906.
Yeah, that's a pretty incredible number. Also, just go back to Qualcomm for a moment. They're taking a look at that fourth quarter revenue on the high end of $10.3 billion. That beats estimates. Also taking a look at the individual segments, right? You have QCT, which is basically what they make for their phone chips. That's coming in quite strong on the high end of about $8.7 billion for the fourth quarter. So these are solid numbers when it comes to guidance. Their licensing revenue also on the high end, coming at $1.55 billion on the high end for the fourth quarter.
You know, a lot of it will depend on what they say also in the conference call about their outlook for the following fiscal year, because that's when Apple's new generation of iPhones come in and the refresh cycle that's supposed to take place there. They're going to provide a really important read on demand from Apple.
Is this new phone? Is this the one that folds?
No,
this
not
is
yet.
just AI stuff.
Oh.
No.
Are you looking forward to that one?
Man.
You want the fold
You got to
thing?
wait a few years for
I'm
that
over
one.
folding.
Samsung does have a folding phone out.
I've heard, yeah.
Apple, not yet.
Yeah, wonderful.
If that happens.
Yeah.
If that happens.
If it happens. But it will be AI capable, right?
We're also going to
new
look
phone,
for
yeah.
we're going to look for some commentary out of Qualcomm in terms of China specifically, also AI. Certainly, that's an aspect for them. But this is, you know, we've seen in terms of some of the phone market and the handset market some weakness. So we're looking, you know, for more commentary about kind of demand later in this year and what it says about maybe the strength or the comeback, if you will. But you are seeing Qualcomm now, guys, up about 7% here in the aftermarket. This is building on a more than 20% gain here in 2024.
Yeah, they did update an investor relations website, so I am able to look through the press release. Cristiano Amon said that third quarter results reflect strong execution of our growth and diversification strategy. With QCT quarterly revenues and EBT margins at the high end of guidance, we're excited about the launch of Snapdragon Series X solutions for PCs and personalized AI experiences. It represents a significant milestone in our transformation from a communications company to a leading intelligent computing company.
I am curious to see how they articulate their longer-term future, particularly given all the reporting we've done at Bloomberg about Apple trying to basically distance itself from Qualcomm with its own chips and things. And obviously that's been pushed back, according to Mark Gurman. But at some point, this is something that Qualcomm is going to have to confront head on.
I just want to hit on ARM Holdings just for a moment here. So just a reminder, their first quarter results came in about 40 cents a share. That beat their revenue, also beat their second quarter forecast. I mean, it looks pretty solid on an adjusted earnings basis. The high end just met in terms of revenue. They see on the high end of $830 million. You look at the operating expenses, though, that could be higher than estimated, coming in at $500 million versus $472.7 million. So note on that, that stock is down 5%.
Okay, we just got earnings out of Meta, so let's take a look at second quarter numbers here. Meta Platform second quarter family of apps revenue, that's the biggest part of its business, $38.7 billion, better than what analysts had expected. The platform's second quarter Reality Labs, a small part of its business, $353 million, missing the average analyst estimate of $376.9 million. As for the second quarter revenue overall, 39.07, beating the consensus estimate of 38.34, and the outlook for this quarter revenue $38.5 billion to $41 billion. Analysts were looking for $39.16 billion, and capex for the full year $37 billion to $40 billion. It had previously seen $35 billion to $40 billion. Analysts were looking for somewhere in the middle of the lower end of that range, $37.5 billion. So like all the other big tech companies, Carol, increasing its spending here.
Well, and this is going to be potentially worrisome, right? When they talked about it last time, we saw certainly the stock take a hit. So giving some clarification around it, but it's not like they're reining it in. The street was looking for it to maybe pull it in even more. If you look at the top end, they're saying it could go to as much as, for the fiscal year, up to $40 billion. The estimate on the street was below that by about $2.5 billion. So we're looking at Meta Platforms, though, up 8% here in the aftermarket. Also talking about fiscal year total expenses, $96 to $99 billion, a bit of a gap there. The street estimate is 97.73. So again, that can be on the higher end. But again, right now, Wall Street seems to be taking it in stride here.
I think it's notable what Mark Zuckerberg said in the press release, that he led with AI. He doesn't talk about the family of apps and the record revenue that they had there. He said we had a strong quarter. Meta AI is on track to be the most used AI assistant in the world by the end of the year. We've released the first frontier level open source AI model. We continue to see good traction with our Ray-Ban Meta AI glasses, and we're driving good growth across our apps. So he does mention the apps there, but he mentions the Ray-Bans before the apps there. I mean, that's like a tiny part of their business, but maybe that's where he sees the growth of the company.
Maybe that's where he does see the growth, and of course that feeds the conspiracy theories about those tan lines that we were talking about last week.
I knew you were going to bring that up.
Kind of interesting as well, too, when we talk about CapEx, how that CapEx spend basically staying in line with estimates for 2024, a ramp up in 2025. But I thought it was also interesting, too. I was looking at some of the ad numbers here, and ad impressions coming in, growth of about 10%, which was slightly below what the street was looking for, and a huge drop from the prior quarter a year ago, when we had about 34% growth, though. That was probably a bit of an outlier.
I just want to highlight for a second the Reality Labs thing. So Reality Labs is saying operating losses will continue for 2024. Their operating loss for the second quarter came in at $4.49 billion. So just to contrast the fact that that area of their segment, right, their virtual reality is losing billions of dollars. It will continue to lose billions of dollars this year, yet CapEx will still be on that high end of $40 billion. How do you reconcile that as a shareholder?
Is it maybe because but the quarter that I just reported on, maybe because there are some beats there, and so maybe they think that they can manage the expectations? It's pretty kind of mind-blowing, because I would have anticipated that the stock would have traded lower on all of those costs. Right now, Meta is up about 5% here. You've got Qualcomm up about 4.7% in the aftermarkets, ARM holding down 7%, Etsy also out, and it's gaining about 2.9% in the aftermarket. So a big drop of earnings. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, keeping a closer eye on Meta. Those results just coming out, 22% revenue growth in the most recent quarter on the back of advertising, but a big focus, of course, on costs. The company basically saying that its CapEx spend in line with estimates for 2024. A bit of an increase expected for 2025. Mandeep Singh joining us right now, who covers this company for us over at Bloomberg Intelligence. Mandeep, what was the most important thing in this release to you?
Ad pricing. I mean, the fact that ad pricing grew 10%, it's a very positive sign that they are applying all those AI chips to good effect in terms of getting more money from the advertisers. And ad impressions going down actually may not be a bad thing, because prior to this quarter, they were increasing ad loads to drive up the ad impressions. Well, guess what? They don't have to show more ads, but the ads that they're showing are getting more money from the advertisers, which is why the ad pricing went up. So actually, the quality of the beat was much better than what I anticipated. And, CapEx numbers not going up is also a positive, because that was a big risk.
Yeah.
How long can they keep spending, and will investors be patient here?
So it's like the ARPU goes up for the advertisements.
Exactly, yeah.
So in terms of a breakdown on that ad growth, I mean, what are you curious about in terms of the Reels business, which is kind of a clone of TikTok, versus Threads, which is a Twitter clone, and right now doesn't even have advertising?
Yeah, I mean, Reels is almost 50% of their engagement right now. So look at how quickly they have transformed the entire business. I mean, Instagram, Core Blue app, all the video content has come about in the last 2-3 years. That's where they made that big push. And Reels is almost 50% of the engagement time. A lot of the ad impressions they were showing on Reels weren't monetizing that well. I think this print shows they're actually monetizing their video ads probably better than YouTube at this point, because YouTube, remember, didn't have a very good quarter. So this quarter actually kind of shows that Meta is doing better in terms of ad monetization.
So the whole Reality Labs operating loss, just kind of, we're cool with that?
Well, when you print numbers like this, I think you get a pass, because even though you are losing, that's another level they can pull. If investors were to, ask them to be more kind of efficient with their spend, guess what? They could pull that lever, but they don't have to, given operating margin expansion and the tailwind we saw with ad pricing this quarter.
Yeah, they've earned it through their ad growth. Mandeep, thank you as always. Mandeep Singh of Bloomberg Intelligence giving us the instant analysis to Meta's results. And of course, Meta shares currently gaining right now in after-hours trade. Let's bring in another voice. David Kirkpatrick is founder of Techonomy Media and, of course, the author of The Facebook Effect. David, so good to speak with you. And let me just get your thoughts first up on the CapEx and in particular when it comes to the reality labs, the reality business, and how that money, that part of the business is still losing money. How much is Meta still spending on the metaverse despite it losing money versus AI? The CapEx number that it gives kind of covers everything, doesn't it?
Right, but if they're losing $4 billion on reality labs, which I just heard somebody say, they're spending way, some 95% of that is a capital expenditure that's just not generating profits or revenue. So, they have a strange view of the future, but I do think given their extraordinary ad growth, as Mandeep just so very eloquently laid out, and the potential they have to continue making so much money from advertising, they really can continue to invest both in AI and in their sort of whimsical metaverse experiment without really suffering very much.
Well, of course not. I mean, when you're generating $40 billion basically a quarter, which is basically the run rate now in revenue for this company on the top line, double-digit growth for a mature company, double-digit growth for a company that, I don't know, 2 years ago in 2022, everyone thought the party was over. And that's when they were doing all that big spend on the metaverse, which you know, David. Investors pushed back on it, letting it be known to Mark Zuckerberg. They didn't like it. He folded at some point, and investors embraced it. At least for right now, investors seem comfortable with these numbers.
He didn't totally fold it either. I mean, he's still spending an awful lot of money on the metaverse, but because of the extraordinary business performance that continues, and I think it's more controversial right now whether the AI investments will pay off, as you often discuss. This is a hugely confusing moment in the development of the technology economy. And I think every one of these companies is somewhat nervously competing with one another, attempting to outspend each other for a very uncertain long-term goal.
Well, David, that's kind of the point I wanted to make. So Google, their revenue comes in at $84 billion in the second quarter, and they get dinged. And then you have Facebook that comes in, and their revenue beats, but it comes in at $39 billion, and then they get rewarded, but they're exposed to ad sales. And ad sales is a global growth factor versus Google and data centers and cloud, which feels more like a structural shift. I just don't get it.
Well, I think majority of Google's revenue is still advertising, so I don't see it as that contradictory. I think it's weird the way that both Alphabet and Microsoft stock dropped after they beat estimates in the last few days. So, investors are strange. I don't think we can always figure out where their heads are at. But look, the fact is that Meta is an extraordinarily well-positioned, extraordinarily well-run company from a purely financial point of view. As you know, I have my serious critiques of them in other respects, but there's no question that the company is just roaring ahead with still the best targeting that any company has, with this extraordinary 4 billion user customer base that's we've never seen anything like this before. It's so easy to take for granted these companies, but they are moving into some areas that are world-altering with very effective business models.
Yeah, a fifth straight quarter of double-digit percentage increase for quarterly revenue. One thing that people bring up a lot, David, is Llama, right? Mark Zuckerberg doesn't have to partner with an OpenAI because they've got their own large language model that they're training. It's open source right now, so my understanding is they're not collecting any licensing fee on it at the moment. You worry that this could be a source of problems for Meta down the road, maybe its ability to keep bad actors at bay. Walk us through your thinking here.
I don't think it's, from a financial point of view, I would not criticize it. In fact, I think it's generated a lot of enthusiasm in the marketplace and among developers. So open source AI has tremendous virtues from the standpoint of a business. The problem with open source AI is that people who are bad have more access to taking that code and using it in any kind of malevolent way they would choose, because they have access to the source code. That's why open source is open. And many of the other AI companies have chosen not to go that route because of their concern, in part at least, that that could be a risk. Now, it's in keeping with Zuckerberg and Meta's longstanding approach to all technologies, which is pretty much throw them out there, and if something goes wrong, figure it out later. That's just, moving fast and breaking things is still their corporate mantra, even if they prefer not to talk about it using those words.
What's sort of the next step here right now, David? Because we talk about this idea that this is still effectively an ad company, despite all the talk about the metaverse and Ray-Bans and all these other things. But clearly Zuckerberg has shown that he has ambitions to try to broaden this company out beyond that. Do you think AI, Ray-Bans, metaverse, whether this all gets folded into one in some form or another, is that going to be the future, or do you think this could be a head fake?
Oh, gee, Romaine, if I knew the answer to whether AI was going to be the answer, the successful profit-generating tool for these companies, I would be. But, nobody knows. But I think their bet is as good as anybody's. And I will say this. I am very negative on the metaverse name change, $4 billion loss, et cetera. On the other hand, if you look long-term, they might be able to find some interesting intersections between their extraordinary AI investments and Llama's success and whatever the metaverse thing turns into. So they have continued to express great confidence that we're going to be able to have sort of virtual presence look like we're actually in the same room. Who knows what AI will be able to do to improve that? So I don't bet against them from a technology development point of view.
All right, David, we appreciate it. Maybe that's what will happen when we take the close on the road. We can all be in different islands and do the close. Maybe in the metaverse. All right, David Kirkpatrick, thanks a lot, founder of Techonomy Media. All right, we got a lot of earnings for you that are continuing to come out. I'm taking a look at MGM. Overall net revenue coming in stronger than estimated at $4.33 billion. You had adjusted earnings also coming in at 86 cents a share. And I do have to say, their MGM China net revenue was up 37% year on year, and that was also a beat. So was the Las Vegas Strip resorts, coming in about $2.21 billion, despite the fact the stock is down by about 3%.
All right, let's take a look at Carvana. Those shares had been oscillating between gains and losses, now up about 9% here in after-hours trading. Revenue coming in as a beat in the most recent quarter, $3.4 billion. Street was looking for $3.2. EBITDA, as well as EBITDA margin, also a beat here in the most recent quarter, and the company providing guidance for the full 2024 year, adjusted EBITDA of $1 billion to $1.2 billion. Even the lower end of that range is more than $100 million above the average of Street estimates. A big part of the reason why you're seeing the shares higher. We should also point out that unit sales of vehicles in the most recent quarter also coming in well above estimates.
All right, let's take a look at eBay. It is moving up in the after-hours trading. In terms of second quarter numbers, it was a beat on the revenue line, on adjusted EPS. Active buyers unchanged from the same time a year ago, but slightly higher than what analysts were looking for. The third quarter revenue outlook of $2.5 to $2.56 billion. It's a range, and the midpoint is just a hair below the consensus estimate of $2.54 billion. Nonetheless, you see that the stock is maintaining its gain in after-hours trading, and by the way, eBay maintains its quarterly dividend at 27 cents a share.
All right, taking a look at Etsy here. On revenue, Etsy actually beat estimates. It was up by 3% year on year at $647.8 million. Its marketplace revenue was also at about over $470 million. That was also a beat. Earnings coming in a little lighter, though. Gross merchandise sales, that's the one to look at. That's down by about 2% at $2.95 billion. It was down 2% on a year-on-year basis. I should point out also the CFO, Rachel Glazer, has announced her retirement. She will remain in her role until a successor is appointed. This according to the company release. All right, we're going to stick with earnings for you. We're going to break down all of them. We got Qualcomm, eBay, Carvana. We'll delve deeper next. This is The Close on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit.
Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
A wave of earnings coming out after the closing bell. Let's get to a roundup of some of those notable movers. Want to bring in Bloomberg's Bailey Lipschultz, Isabel Lee, and Alexander Semenova. Bailey, let's start with you on Qualcomm.
Yeah, Alex, who says you have to be focused on AI to have fun in the chip space? Qualcomm up more than 6% post-market, beating expectations, driven by a lot of demand for smartphones. Stock was up more than 8% on the day, given that kind of rush back into semiconductors names. Want to call out their strong third quarter revenue guidance, expecting between $9.5 and $10.3 billion above the midpoint what Wall Street was looking for at $9.7 billion. Also saying profit will be between $2.45 and $2.65 a share. Street had been penciling in $2.45, so well above what Wall Street was looking for. Another big print, though, from the semiconductor space in the wake of AMD. Going to be interesting to see if this follows through tomorrow. Isabel, what's going on with retail?
I'm looking at eBay. We have the company reporting adjusted EPS from continuing operations that beat estimate. You see the stock higher by around 1.7%. The number came in at $1.18, so that's higher year over year and higher than the $1.13 estimates. It's also a beat across the board. Net revenue came in higher, as did active buyers. We also have gross merchandise volume coming in higher than expected. So the reason why I think we're not seeing a bigger pop is really the third quarter revenue estimate. So the company reported a $2.5 billion to $2.56 billion, so that's a range. And the estimate is right smack in between, around $2 billion. 2.54 billion. All the numbers are confusing me, but it's just within the range. As for quarterly dividends, eBay maintained that its regularly quarterly cash dividend is at 27 cents per share, and the dividend declaration date is July 31. Stock is still up at around 1.6%, but year to date, it's up 26%. What do you got, Alex?
Hey, Isabella, I'm looking at used car retailer Carvana. Yes, that is the maker of those massive car vending machines. The stock is up about 11% here. That is after the company reported revenue and vehicle sales that beat Wall Street estimates, also reporting a surprise profit. Net income in the period was $48 million. That handily topped analyst estimates for a loss of $16 million. Carvana, of course, has been on a tear since late last year after a turnaround in its business where it cut costs and reduced some of its debt. It was battered back in 2022 during the post-COVID rout as higher interest rates shunned some buyers out of the used car market. But since then, it has returned to being a profitable leader in the industry. In fact, analysts at BTIG called Carvana's margins industry leading. It has reported gains after 6 of its last 8 earnings reports, including the last 2 where it rose more than 30% each time. The stock was up about 152% this year going into this report. Still, though, not a lot of love from Wall Street. The stock has 6 buy ratings, 14 holds, and 3 sells. It's going to be interesting to see how this move holds up tomorrow. Guys.
Yeah. Well, who needs a buy rating when you got a 150% rally rally in 6 months. Our thanks there to Alexandra Semenova, Isabel Lee, as well as Bailey Lipschultz. A nice roundup of some of the earnings here in after-hours trading. We should point out Carvana, at least among the mid to large caps, the biggest mover in after-hours trading, up 10%. And I'm still astonished at just how much this stock has rebounded. I know it's nowhere near its old highs, but when you consider it dropped 99% and the fact that it's rallied, almost 200%
it's
off
a massive
those lows.
roller coaster ride. I know that you were recently in the market for a car. Did you go to a vending machine to get a car?
Yeah, I was a little disappointed. There was no vending machine. I bought a new car, so I don't know. Maybe they don't do that with a new car. A new car, they just jack you for as much money as they can and then push you out the door.
True.
But I have to say, it was kind of interesting to see too the lack of inventory on the lot. And I don't know if this is just indicative of that particular dealership, but it was still pretty sparse. Not quite as bad as what you saw if you went to a dealership in 2021 or 2020, but it was certainly still sparse.
You know where you could probably get a car? Tesla. You could probably get a Tesla. They're not going to have any inventory issues on that one. I mean, you can make an argument that it's the EVs that are plethora at the dealers if you need
that was the other thing too. You didn't see a whole lot of EV or even hybrids, other things.
Yeah,
I mean,
definitely
a lot
hybrids.
of ICE vehicles were available if you want them.
No, the hybrids are hard to find, but you can also go to like Hertz or Avis selling off their used EVs as well.
They're still like almost 30 grand.
I know.
I mean,
For
at
what?
best, you get like maybe 19
for used
21 for a used Tesla.
Oh.
Yeah.
But that's actually enticing some people. I mean, considering some of those were like 50, 60 grand brand new.
I suppose, yeah.
All right, coming up, we're going to dive a little bit deeper into those earnings out of Meta. Stick with us. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Results coming out of Meta Platforms here. Better than expected sales in the most recent quarter. That ad business still the juggernaut that it's always been. Some concerns, though, about CapEx spending. CapEx spending that's going to hold, at least in 2024, at current levels. 2025, though, the company's saying it will continue to go up as it pushes deeper into the AI space. Kurt Wagner joining us right now, who follows this company for us here at Bloomberg News. And Kurt, let's start off first with the CapEx side of this, because I think a lot of people were wringing their hands coming into this report. I think they got some good news that the spend, at least for right now, isn't going any higher than where it's been, though they did kind of intimate here that 2025, it will go up.
Yeah, I think the story with Meta right now is just simply the balance between investing in this long-term AI stuff, both with LLMs and other chatbots, things like that, and also the metaverse, and staying focused on, the core money-making business, right, which is the advertising business for Facebook and Instagram. And so I think that is the tension, as you point out. They've said, hey, in 2025, we are going to increase that spend. It shouldn't really be a surprise to people. Mark Zuckerberg has been saying this publicly pretty much every time he goes out and speaks these days. But I think, getting that confirmation from the company, knowing that they are going to continue to invest billions of dollars in this space, is giving some people some pause.
But, they narrowed the range that they're going to spend on CapEx for